Hey, good morning, everyone. Marty Mazzora here. In fact, call it noon, 2 minutes to noon on Friday the 13th, 2024. I'm going to do just a really quick video for you. I'm just about to score our economic index for the week, but paying attention to the data that have come through this week, I don't expect any measurable change to report to you. I did this week publish part 2 of our typically lengthy year-end letter. It's typically multiple parts. May only be 3 or 4 this time. I think that we can get to the gist of what to look forward to, at least what we think the odds favor, and how we're going to be approaching that, probably in 1 or 2 more parts. But today, what I do, though, is just share with you what I'm finding to be a very interesting look in terms of equity market breadth, and then maybe just quickly paraphrase the main points of part 1 and part 2 of the year-end letter, because I think those are very important points that I need to really express and emphasize. But since I have my Bloomberg screen up for you, I think I'll just jump through that first. So again, on market breadth, this has been a theme for, I'd say, this post-COVID stretch that we've had that's been pretty consistent, and that is, for the most part, historically dismal breadth. And breadth would be, to what degree in an up market, in this example, are all or most of the boats rising with the tide. And we've had improvement off and on, say over the course of 2024, for example. And I know that Wall Street has, for the most part, adopted the narrative that, bad breadth is not necessarily bad. It just means that, sure, a small concentration of stocks are moving the major averages. And if we're not going to have a recession and we're going to have that soft landing, that just means that the rest of the market is going to catch up. Now, that's a narrative that I'm very willing to explore and accept and keep an open mind to, and even allocate a little in that direction just in case that's how it plays out, which we've done of late. But history says, be very, very careful with that. The last time we had breadth that was this concentrated was right before the tech bubble burst. And, for the NASDAQ, that was an unmitigated disaster. And, if 50% is a disaster, it was for the broad S&P 500 as well. So with that topic in mind, in front of you is a look at the S&P 500 over the past month, which is the white line. The S&P 500 equal weight over the past month, which is the green line. And by the way, this index doesn't update for us daily on Bloomberg, where these do, but it's down another 0.5%. That's a big line there. It's down another 0.5% this morning, whereas the broader S&P 500 is actually flat. It's up nothing so far. But so what this tells you is that the stocks, for the most part, are down today. But down over the last month by 0.2%, while the S&P is up 1%. The NASDAQ 100 index is up 3.5% over the last month, where the NASDAQ equal weight index is just barely up 0.8%. So anybody that thinks that we've had this rip-roaring rally in U.S. stocks, it's a very nice rally for a very, very concentrated group of stocks. Again, beware, because often, I remember vividly, late 99, Cisco kept moving up, and it was the infrastructure stock that could never go down. The rest of the market was rolling over. Finally, Cisco caught up to the tune of about a 90% drop before it was all said and done. And it was a great company that continued to have earnings. And many people, yours truly included, have been looking at the analog for NVIDIA in today's setup. Another look at breadth is the S&P 500 on the top. The percentage of S&P 500 companies that are above their 50-day moving average. So you can see that's the green line here for the index. It is well above its 50-day moving average, when only about half of the stocks in the index are actually trading above their 50-day moving average. That is very concerning breadth. Now, we've been looking at these analyses for many years. I just ran it back to the beginning of 2019 for illustration's sake. So right before that, 35% decline in the S&P. It was more for other averages like the Dow. You can see we were having a long extended negative divergence in the number of stocks above their 50-day moving average versus the index. We had it here when we had these corrections in 2020, later in 2020. And then we had it here right before peak to trough, about a 30% decline in 2022. And you can see it works in both ways. You can see here we were getting a bullish signal as we had a higher low, right? And in here, as the market was going lower, we were bottoming out in terms of breadth, and that was a good sign that the market was going to potentially have a pretty good run. Right before this 10% correction in 2023, you can see we had a bearish divergence, bullish as we came out of it. But folks, nothing that goes with this long rising wedge pattern other than a very concerning look in terms of this indicator. So this suggests that we should be somewhat careful and be looking out for something more than perhaps just a single-digit correction, but we'll see. That tends to be how these play out, but of course, nothing ever happens 100% of the time. Another one is simply the advanced decline line for the S&P 500. This is just a 2-year chart. Same kind of thing. As you can see, when the number of decliners exceeds the number of advancers in an up market, that's a sign that you should be, maybe looking out for something below, so to speak. You can see here we had a negative divergence, just had a little bit of a dip. I think that was 6 or 7%, maybe 8% there. And here we are just kind of moving sideways, but a noticeable bearish divergence on the advanced decline line. The one that, pardon the term, but the scariest one is the NASDAQ composite advanced decline line. Historically speaking, folks, you do not want to see this pattern of this pattern. This is the advanced decline line for the NASDAQ comp. Last time it looked this threatening was right before a 78, call it 80% decline in the NASDAQ, or before a 56% decline in the NASDAQ. And then all along here, you can see I've done some work on this. Basically, I just plotted dips in the market that followed bearish divergences in the NASDAQ advanced decline line. And you can see there's been a few bullish divergences that signaled, rallies as well. So we're not getting that right now. So another thing, this has been going on a very long time. And the market can stay irrational by many metrics for a very, very long time. So this is not in any way a sell signal. It's just a signal that, be careful. Have something that protects you against, potentially massive downside. Okay, so then just a quick look at the technicals. This is the monthly chart. We've burned through pretty much what was a bearish divergence on the MACD. So this is no longer a bearish sign. In fact, it's a pretty strong buy signal on the monthly MACD. This is a rising wedge pattern, however, which is by itself, is a bearish pattern, but it's tried to break below. It hasn't, and until it does, this is still an uptrend. It is overbought. You tend not to want to be overbought on the monthly, right? You can see it's rare, and when we are, we tend to get some pretty good corrections. And it is a bearish divergence on the relative strength index. So, somewhat ambiguous, net, probably somewhat concerning. The weekly chart is a bit more concerning, so a little shorter time frame. Very definable upward wedge. We broke out of this one, had that little bit of correction for a few weeks. Here we have still, which would be a negative divergence on the MACD, and quite a negative divergence on the RSI. And now taking a quick look at the daily chart. This one is, again, the most concerning, but we got a Fed meeting next week. It's really good seasonality. I'm not overwhelmingly bearish on the near term. I'm just telling you folks that these just aren't great looking setups. And I've been telling you that for quite some time. The longer this goes on and the more these setups do not improve, notwithstanding a little better look on the monthly, the more risky this market becomes because valuations just get further and further stretched. So we had this rising wedge pattern there. We did break below it. We had negative divergences. We had a sell signal for a minute. conditions, policy, promises, what have you. Save that. Just quite the uptrend line here on the daily. We're breaking alongside that. We've got resistance right here that we keep pounding against. Technically speaking, odds definitely favor breaking that support, not resistance. That would be your sell signal down to the 50-day moving average. You'd want to buy that if you're bullish. You'd wait for the breakout below if you're bearish, and then you'd go down further from there. Lots and lots of stuff. Headline risk in both directions, could get in the way of any technical analysis, but that's the look of it to me right here as I speak. Then the NASDAQ 100, let's just do the daily in the interest of time. We're just pushing up against the top end of this channel in here, kind of a rising wedge as well. Still somewhat of a divergence, bearish divergence, almost overbought. Again, nothing compelling. It's not the kind of market you'd want to go barreling into. Let's put it that way. The dollar has been stellar. Just no ifs, ands, or buts about it. I could argue for another bullish flag pattern. As you can see, I've kind of plotted it out here already. It just kind of continued to flag up. And here we are, 1, 2, 3, 4, 5 days in a row. Market's been kind of all over the place, in the midst of a higher dollar. Not good for necessarily the emerging markets part of our portfolio, which we're very bullish on long term, which I'm going to touch on here in the next part or two of the year-end letter. But a strong dollar ultimately is probably problematic, particularly for non-U.S. securities. I can tell you the incoming administration and its appointees are fans of a weaker dollar. But when we're talking about trade wars and tariffs, if you're on the other end of the tariff story, well then your currency will go weaker to offset the impact of the tariff, which means a stronger dollar. So it's going to be real interesting to see how this plays out. My best guess, and it's not just my guess, is that, for example, China perhaps allowing the yuan to weaken right here. I do think that the administration is going to want these people to come to the table with a promise not to devalue, if anything, to work to devalue the dollar a bit against their currency, which would be good for U.S. multinational companies. And so our long-term dollar thesis for quite some time now has been a weaker dollar. We think that is a resoundingly strong and solid thesis. But I've said from the get-go, while the rest of this cycle plays itself out, the dollar is going to probably lean stronger. And if we get that recession, history says we will see a strong dollar during a recession. It's in the aftermath. It's as we get into the next cycle that we expect a weaker dollar, and we expect to fully exploit that in client portfolios. And then lastly, the quick look at the 10-year Treasury yield. At about 4.5 is where this lately has been getting problematic for stocks. So yields have been going up. Fed's probably going to cut interest rates 0.25% next week. Yields been going up, responding to the prospects for fiscal stimulus coming and so on, going up amid the Fed loosening policy. Jerome Powell really has a lot of splaining to do, so to speak. When we look deeper under the surface, quite frankly, we actually see reasons to be very, very careful and maybe be easing or be net easing from a Fed policy perspective. But that certainly is not consistent with the headlines. And with that in mind, let me just go ahead and pull over part 2, which those of you who subscribe to the written blog just got this day before yesterday. And what I talk about, actually, that's part 1. And what I talk about here is that, the market is really feeding on this Goldilocks scenario, right? And that would be, soft landing. And for stocks, that would mean higher prices amid declining bond yields. That's a narrative that enjoys popular support. Empirically speaking, not so much. recessions and bear markets, with rare exception, follow Fed tightening cycles, which is what we had. That's the Fed, quantitative tightening, where they're reducing their balance sheet and raising interest rates. Typically, they loosen into a recession. So this looks different this time right now. And I acknowledge here that as time goes on, we were very much, by the way, in the 2023 recession camp. That didn't happen. Odds have stayed there throughout 2024. Didn't happen. So now the soft landing story looks much more like truth than fiction or fantasy, right? But then again, if recent developments are any clue, and as I just showed you in bond yields, the notion that the market is going to go up amid declining interest rates are, well, declining, right? And so I show that anticipation of Fed funds futures by the end of next year, almost a full percentage point higher than they were just 3 months ago. I showed how the 10-year Treasury yield, and it's going up again today, has risen since then, how the stock market has tended to go negative in terms of directionally when rates have gone up and vice versa. So that if we're going to have higher rates, particularly with these valuations that I showed in part one, and I'll show that again here in a second, that's a terrible headwind for stocks. So anyway, that's the general point I was making. And then interestingly, two research firms who we pay a not small amount for their research are BCA and MRB Partners, Macro Research Board. BCA sees recession in 2025. I just started a few minutes ago reading the latest from their global investment strategy team, and they see an end of year for the S&P next year in the low 4,000s, which is way lower than it is right now, and they give their justification for it. MRB, on the other hand, is still bullish on the global economy. They still think that you can overweight global equities, but even they are cautious. They say that returns will be lower, muted, greater market volatility. BCA says overweight bonds because they think the economy is going down. MRB says underweight bonds because they think the economy is going to hang in there. But again, much more muted returns than in 2024. The risk reward ultimately will shift in favor of non-U.S. equities. We are very much in that camp, but we're not going there in size just yet, especially emerging markets in our view. And I'm going to outline that here in the written blog over the next 2 or 3 weeks. Our own index is just slightly in the negative. I featured the 43 data points that we track in the index currently, and I highlighted how we're scoring them. And you can see right here, the consumer, right? Retail sales, auto sales, personal income, and so forth, all are still green. So all still positively impacting the economy. There's lots we look at underneath these charts, rate of change, trends. We do technical analyses on these as well. So I just thought I'd throw these up here to give you a visual and to highlight how we're scoring each one. And then just kind of in summary, per our own assessment and the competing narratives of the two firms I featured there, resoundingly mixed picture for U.S. equities, leaves us inspired to remain very diversified across classes and across the globe, plenty liquid, hedge that U.S. exposure, and so on. So now just real quickly to part one, and I'll let you go. 3 rules of investing. Howard Marks is just an absolute wealth of knowledge, wisdom, information. His 3 rules: risk control first, value over price, and just be patient. Don't worry about what the market's doing. Stick to your theses, but test them. Change your mind when you're wrong, etc. And then Warren Buffett, rule number 1, never lose money. Rule number 2, never forget rule number 1. For us, we just need to remain 100% clear-minded and objective at all times. So our question, can you see without any prejudice, or can you observe without taking sides, without defending your conclusions, while suspending your beliefs and your dogmas and so forth, and be totally free to observe clearly? The question posed not for investors, but just for life, by Jiddu Krishnamurti. So, and then I just kind of go on and just what I wanted to show you here, and just read it if you haven't. If you're not a subscriber to it, just go to blog.pwa.net. Anyway, and I've shown you these before, so I don't need to spend a lot of time on it, but the Price to earnings ratio, and earnings can be manipulated. PEs are historically high. There's just very little equity risk premium to game here these days. Price to sales, which is more legit, is virtually at records. Price to book at scary levels. The cyclically adjusted price to earnings ratio is like one or second or third all-time high. Supposedly Buffett's indicator, the market cap to GDP ratio is at an all-time high. And Americans are holding record shares of their assets in equities. The last time they did that was right before the bust in 2000. And then I just kind of paint the picture of our basic core, very moderate to conservative portfolio that we're managing right now. It's about half stocks, biased toward U.S., biased towards things like consumer staples and healthcare. We do have some tech, which has been good to own. We do have some energy exposure. We did up our financials and materials here recently after the election. We also upped our small cap exposure. And then a little bit in bonds, a lot in treasuries. Gold's still a pretty good chunk. That's been good for us. That's gave us a 30% return this year. Ag gave us close to that. Silver gave us that as well. Palladium's been pretty flat since we bought it. And then I give an example of a change I just made and so forth. So anyway, folks, let me just stop there. Lots to be excited about. I mean, there's a lot of potential positives for the market that's going to come with fiscal policy and so on. As I've expressed, though, we have a different setup than we did in 2016 because we have serious inflation risks that we didn't have then. So if you push too hard on the stimulus, you may see rates rise, and that's going to be a headwind for stocks. If you go too hard on protectionism and the tariffs and so on, that could lead to weakening in the global economy, and this market isn't remotely discounting a recession. And there are some very credible analysts and economists who actually think there's one coming this next year. So that would be problematic for stocks as well. So folks, this is not yet a time to be adding a bunch of risk to portfolios. It will be, as I've said over and over here on the blog and in client meetings, looking forward to the time when we can get much more growthy in our approach, but we need to have the fundamentally strong set of conditions that allow us to do that. Folks, that went longer than I expected, but I appreciate you if you hung in here this long. Hope you have a wonderful weekend. And over the next week or two, look for part 3 of our year-end message. Take care. Bye-bye.